Here's 5 loan programs for a mortgage that you didn't even know existed. Now, first, you don't know about these programs because most lenders don't use them. I'll even say probably 95% of lenders don't actually use these programs. And they don't use them because most lenders will only do what's called a qualified mortgage. A qualified mortgage is something like a conventional, VA, USDA, FHA, where they're following government guidelines. Now, these loans, a lot of them follow a lot of government guidelines, but there's small pieces where they don't. And that's why you really don't know much about these programs at all. So to get it started, number 5, this is going to be a no credit history. So in most cases, you have to have some type of a credit history, some type of a credit score to actually get approved for a mortgage. With this one, you don't need a credit score. You don't need any credit history. What we're going to do instead is we're going to verify different payments that you've made to be able to show your credit worthiness. So we're going to look at things like utility bills, a phone bill, your bank statements, rent verification to be able to verify that you are responsible enough to be able to make your payments. Number 4, this is going to be a no income verification. So with this one, the way this one works is for a lot of people, they don't have income that they can verify. Maybe you're self-employed, but you have a lot of money down. So with this one, we're generally looking for at least 20% down. But what we do is we just say, hey, you have 20% down. Cool. You say you make your income. Cool. You're approved. Number 3 is asset utilization. When it comes to this one, you may be somebody who just doesn't have a lot of income, again, that we can verify. Maybe your income's a little bit lower versus the house price that you're trying to afford, but you have a lot of assets. You have a lot of investments, money in the bank, money in savings and checking accounts, stuff like that. Or it can even be money in a retirement account. All we're going to do here to be able to calculate your income is we're going to take that amount that you are going to have left after your down payment, and we're going to divide it in months at 5 years. So we're going to divide that amount by 60. So what that means is, let's say you have $500,000 in the bank right now. You now qualify with a monthly income, $500,000 divided by 60 of about $8,300 per month. Then number 2, this is a bank statement loan. A bank statement loan is going to help out a ton of self-employed borrowers because when you go to qualify for a qualified mortgage, a conventional, FHA, VA, USDA, they're going to use your income only off of your tax returns. Now, for a lot of self-employed people, myself included, we want to write off our expenses. We want to be able to reduce our taxable income because there's expenses that we have as business owners that we don't want to have to pay taxes on that income. So in a lot of cases, our income numbers are a lot lower and it's harder to qualify for maybe the house that we can actually afford. So when we do a bank statement loan, we look at either 12 months or 24 months. We go through and look at the actual deposits and qualify you off of those deposits. So in almost every single scenario, you can get qualified for a lot more just by going off of bank statements versus tax returns. Then number 1 is called a DSCR, which stands for debt service coverage ratio. This loan is meant for investors and it's going to completely change how you can invest in real estate. First, when it comes to verifying your income on a normal loan, you need to submit pay stubs, W-2s, bank statements, tax returns, all that stuff. With this, the only thing that we do is we get an appraisal showing that the proposed rent is going to be more than the monthly payment. Then with income, you're qualified. When it comes to how many doors you can buy with a regular conventional loan, you can only do up to 4 unit properties. With a DSCR, you can go up to 10 units, where normally you'd have to do a commercial loan to be able to do that. With the DSCR, you can also close in the name of your company as an LLC. With a conventional loan, you have to close in your own name and transfer the title to your LLC, which is still going to leave you room for having liability if something were to happen on the property and you get sued personally. And with the DSCR, you're going to have a fixed rate, where usually with a commercial, you have to go with an adjustable rate. So as an investor, you're getting best of both worlds with a commercial or a regular conventional. So if any of these loan options are something that you might want to try to get qualified for, might want to talk to about specifics for your options, make sure you reach out, give me a call, send me an email. Happy to help out. We'll see you in the next one.